Gold may have taken a bit of a beating in the spot markets on Wednesday, following some much-needed stability returning to the capital markets. But it doesn't seem to have fazed the world's largest gold miner. Posting record free cash flow in your first quarter financial results, however, does help things a bit. And so does providing $1 billion worth of total returns to shareholders in the form of stock buybacks and dividends. So, how did Newmont do? Let's dive in. Newmont in the first quarter of 2025 recorded revenue of $5 billion, which was actually down from the $5.7 billion recorded in the fourth quarter of 2024, but up 19.7% on a year-over-year basis from $4 billion in the first quarter of 2024. Analysts had called for $4.74 billion in revenue, meaning Newmont beat expectations by about 6%. That revenue figure follows Newmont recording an average realized gold price of $29.44 on a per ounce basis, which was a $301 jump just from the fourth quarter, and an increase of $854 an ounce on a year-over-year basis. Net income for the fourth quarter totaled out at $1.9 billion, which was an improvement of over 1,000% from the $170 million recorded in the year-ago period. Adjusted net income, meanwhile, improved less dramatically, moving from $630 million, or 55 cents per share in Q1 2024, to $1.4 billion, or $1.25 per share in the first quarter of 2025. Analysts had called for EPS of 90 cents a share on an adjusted basis, meaning that Newmont beat expectations by about 39%. With that being said, however, adjusted net income was down from $1.6 billion and EPS was down from $1.40 in the fourth quarter. So things aren't exactly as rosy as they may seem here. Adjusted EBITDA, meanwhile, improved from $1.7 billion to $2.6 on a year-over-year basis, a 55% improvement, while falling 14% from the $3 billion recorded in the fourth quarter. Net cash from operating activities improved to $2 billion from $776 million in the year-ago period, while cash flow improved from negative $74 million in Q1 2024 to $1.2 billion in Q1 2025, which was a record for the first quarter, but still down from $1.6 billion in Q4. As for the balance sheet, Newmont ended the first quarter with $4.7 billion in consolidated cash, and a further $67 million of cash included in assets held for sale. Total liquidity is said to sit at $8.8 billion, which includes $4 billion available on a revolving credit facility. The strong cash position, of course, follows Newmont completing its divestiture program that they announced last year, with the sales of Musselwhite, Eleanor, and Cripple Creek and Victor being completed in February. $2.5 billion in cash proceeds, net of tax impacts, was received during the quarter, with more to come following the sale of Porcupine and Icam being completed in April. Finally, Newmont has indicated that they have reduced their debt position by about $1 billion since the start of the year, which includes $928 million in 2026 notes that were redeemed back in February and $75 million in market purchases of that debt. Newmont's reported debt to adjusted EBITDA multiple currently sits at 0.3 times. Okay, so let's cut to the chase and get to what everybody really wants to hear about, the production results. Newmont in the first quarter produced 1.54 million ounces of attributable gold, which is comprised of 1.3 million ounces of gold from the Tier 1 portfolio and 35,000 tons of copper. Production from non-core assets, which have since been divested, totaled 195,000 ounces. In terms of production, it was the worst quarter recorded by the company in some time, regardless of if you're looking at just the Tier 1 portfolio or the entire thing. Production was down from 1.68 million ounces in the year-ago period and from 1.9 million ounces in the fourth quarter. If you want to exclude the non-core stuff because Newmont is only focusing on the best of the best, Q1 2025's production figure of 1.34 million ounces was down from 1.38 million in the year-ago period and from 1.59 million in the fourth quarter. This decline in production naturally led to higher costs, on top of the increase as a result of higher royalties paid out due to the rising value of gold. Cash costs in the fourth quarter came in at $12.27 an ounce, an increase from $10.57 in the year-ago period, and from $10.96 in the fourth quarter. All-in sustaining costs, meanwhile, increased from $14.39 in Q1 2024 and $14.63 in Q4 2024 to $16.51 an ounce in the first quarter of 2025. As Aidan put it, the average realized price of gold in Q4 increased by $301, while the all-in sustaining costs increased by $188, which isn't the greatest economics. As Mike Barnes put it, Newmont is stealing defeat from the jaws of victory with these numbers. Well, Nevada, where Newmont has a JV with Barrick, is a total mess. Attributable production here was down 23% quarter over quarter, from 280,000 ounces to 216, which cash costs increased 21% and AISC increased 20%, which is also not a good sign for Barrick, the other industry bellwether. Production was also down dramatically at Brucejack, Cerro Negro, and Tanimi. In fact, quarter over quarter, production only improved at 3 operating mines out of the 14 Newmont counts in their portfolio. And of those, one of them improved by just 1,000 ounces. So not a great quarter for the Tier 1 portfolio overall. Copper production, meanwhile, was down across the board. That being said, Newmont has indicated that it is firmly on track to achieve its 2025 guidance, which calls for 5.9 million ounces of production this year at a cash cost of $1,200 an ounce and all-in sustaining costs of $1,630 an ounce. Q2 production, meanwhile, is currently forecasted to remain roughly equal to figures posted in Q1, save for those non-core asset divestitures. All right, so let's wrap it up. Newmont's Q1 results are a good example of why you shouldn't always just look at the headlines. A strong EPS and revenue beat moved markets, and record free cash flow for the first quarter was great to see. But when you actually pop up the hood and take a look at what's inside, things aren't quite as rosy, with quickly rising costs and clear production issues at a handful of large operations. The massive jump in the price of gold, however, played a big role in masking these issues, driving the algos to do their thing. All right, everybody, we have just kicked off Q1 earnings season. Guys, if there's stories you want us to cover, let us know in the comments section. Guys, also, if you enjoyed this video, please hit that like button. If you haven't already, subscribe. And guys, thanks for watching.